unprecedented amount of support. It's not trickling down, and the loans they seem to be giving are ones that are already being guaranteed and underwritten by the government of Canada. Does that worry you that this doesn't seem to be working, all this massive amount of supports to Canada's big banks, except for them, of course?
Governor.
Well, look, Deputy Governor Wilkins and I are not here to defend the banks. But let me just say a few things. First of all, as Senior Deputy Governor highlighted, OSFI regulates the banks. They have imposed some restrictions. Banks can't increase dividends. They can't increase buybacks. And the restrictions that OSFI has imposed, we're not the U.S. We're not the U.K. They're imposing restrictions that are appropriate for Canada. With respect to the response of the banks, this crisis, it's worth underlining, this crisis is very different from the one we faced in 08 and 09. That was a financial crisis. And banks, particularly in the US and in Europe, were very much at the center of that crisis. There was a huge credit crunch. That's what caused the recession. This crisis, and in the last dozen years since the financial crisis, there has been a tremendous reform effort in the financial system, and hundreds of billions of dollars of additional capital have been built up. Liquidity is much reinforced. Leverage is much lower, and that has put the financial system in a position this time to be part of the solution as opposed to the problem. And banks in Canada, look, I recognize that not every person feels like they've been well treated, and they're not happy with the pricing, and they found the negotiation with their bank unpleasant. But banks in Canada have deferred 700,000 mortgages. They have increased business credit substantially. Loan growth to businesses is up about 30%. Loan growth to households is actually down, which really reflects what I was talking about earlier. Households, the government has replaced the income that households have lost. Household savings are going up. They're not shopping as much, certainly not for large purchases. So their credit growth actually has slowed. But for businesses, banks have dramatically increased their loans to businesses to help businesses bridge across that. And from the Bank of Canada's part, by lowering our policy rate and by embarking on large-scale asset purchases that have lowered yields at the curve, the cost of those loans to businesses has gone down. Business loans are down about an average. The interest rate is reduced by about an average of about 140 basis points. Okay. So it's not perfect, but they are providing part of the solution.
Okay, thank you all. We are quite substantially over on that round. Mr. Morantz, and then on to Mr. Fragaskatas. Marty?
Thank you, Mr. Chair. Thank you, Mr. Chair, and congratulations on your appointment, Governor. I want to just circle back to the question of interest rates, and the reason I want to do that is when it comes to basically the relationship, if you will, that millions of Canadians have with the Bank of Canada, whether they realize it or not, it comes down to the interest rate, because that's what affects their pocketbook. Now, you said at the beginning that the overnight rate at 0.25% was the lower bound, the lower boundary of the rate, and you also said that you don't anticipate rates going up at all. So are you of the view basically that it's going to be 0.25 for a long period of time? How long might that be?
Well, we're not here today to take monetary policy decisions. As I indicated in my opening statement, the focus in the initial months of the crisis was very much on restoring orderly market conditions, and we are pleased to see that market conditions are normalizing. And so with that, we are turning our focus more to monetary policy. And an important step in that regard will be the publication of our monetary policy report in July, where we will provide an outlook for the Canadian economy, recognizing there is still a lot of uncertainty, particularly around the evolution of the pandemic. I imagine it's going to be more of a scenario, possibly with some risk scenarios around that. But it will provide us a planning scenario, which will be important for the calibration of monetary policy, because, as you're aware, what we do today affects inflation with some lag, and so we have to look forward. So those are the things that, that's sort of the next step in the process to determine how much monetary stimulus will be needed and help us figure out for how long. But,
so is your inflation target still going to be 2%, or are you going to be changing that target?
The target has been 2%, and I'm going to ask Deputy Governor Wilkins to say a word about our research program related to renewal. The target has been 2% for close to 30 years now, and it has served Canada and Canadians extremely well. We are one of the I think strengths of our inflation targeting regime is that we do review it every 5 years, and we are in the process right now of reviewing it, and we are and will be consulting with a broader range of Canadians on that. And I'll ask Senior Deputy Wilkins to say a few words about our research in that area.
Sure. I'll be brief because we've spoken at length about this in different venues. We're conducting an extensive research program, which is doing if you like, a horse race between different monetary policy frameworks, one of which is the one we have today, 2% inflation targeting. Examples of others are a dual mandate, so something similar to what they have in the US that also looks at not only inflation, but full employment, price level targeting, among others. We've got a set of clear criteria for choosing which one seems to be best, knowing well, as the governor just said, that 2% has served us extremely well. And those criteria are really how well do they serve Canadians in terms of stabilizing the labor market, stabilizing production, and will they stand the test of time in different kinds of environments like the one we have today? We're expecting to consult widely with Canadians. You'll start to see our research work out there, and the objective is to have an agreement signed with the government in 2021.
Mr. Morantz, go ahead. We'll give you another minute, Marty.
Back to the governor. I'm having a little trouble understanding exactly what the reticence is around discussing interest rates. You seem not really quite ready to go there. You have said in this meeting that you have no plans to raise them. They're at the lower bound. Are interest rates going to stay at that lower bound, or do you think they're going to rise? And one of the other things that plays into this is, and you mentioned it earlier with the mortgage deferrals, many people have discussed now or described what they see as the deferral cliff. So I don't think we're anywhere near the end of this crisis in terms from a monetary perspective. How long can the bank keep this up and not have to deal with the possibility of inflation?
Yeah, Governor, the floor is yours, but we don't expect you to come to this committee and get into speculation. This is not the place for it, I do not believe. Governor, the floor is yours.
Well, thank you, Chair. I can either give you a very long answer or a very short answer, but I think the Chair wants me to give you a short answer. So, I just
want to say, Mr. This isn't speculation. Your immediate predecessor in this committee only a few weeks ago said, and I quote, "Interest rates will certainly go up." So pardon me if this isn't a real question that I think you should be answering. Do you think they'll certainly go up as well? That's not speculation. That's the opinion of your predecessor. What do you think?
Over time. Go ahead, Governor.
Someday we will get through this. The economy will be recovered, and interest rates will, start to move back to more normal levels. But we're in a deep hole. and it's going to be a long way out of this hole.
Okay, with that, thank you all. We'll turn to Mr. Fragiskatis and then on to Mr. Cumming. Peter.
Thank you very much, Mr. Chair. Governor, congratulations on your appointment. Deputy Governor, it's great to have you back at Finance Committee. My friend, Mr. Polyev, talked about insolvency. I want to ask you about insolvency, but in a different way, and you'll indulge me if you could. It is a hypothetical question. I realize that, but I think it's an important question.
I don't like hypothetical questions.
Okay.
I will tell you that up front.
I haven't asked it yet. I don't
Okay,
think it's
I'm
one
listening.
that I don't think it's one that compromises your position or the bank's perspective. But I did want to ask you, how many households would have become insolvent if the Bank of Canada did not take the measures it took to secure and stabilize the Canadian economy and to protect Canadians by extension? And how many households would have been in a difficult position if the Canadian government did not introduce the various programs it introduced? This includes the CERB, the wage subsidy, the Canada Emergency Business Account. Do you have any thoughts on that, Governor?
Well, I don't have the precise numbers that you're asking for. As we start to revise our, as we start to come to kind of a base case or central scenario for the economy going forward, with the economy is now stabilized. We've last month of May, we saw some job growth. We are expecting that to pick up. So we are now in a position to start thinking about the path of the economy going forward. And as we do that, we can start looking at the we can start evaluating the effects of different policies. But I think it's a bit premature. I don't have those numbers. Senior Deputy Governor Wilkins does have some information, I think, from the.
Well, I appreciate that, but let me put the question another way. And I realize I'm not expecting you to have numbers on this, not you, Governor, not you, Deputy Governor. But suppose, let's just engage in the counterfactual here. Suppose that the Bank of Canada did nothing. Suppose that the federal government did nothing in the face of COVID-19. Is the prospect of a depression possible? Because when the parliamentary budget officer testified at the committee just a few weeks ago, he described a situation that very much mirrored a depression situation. When your predecessor testified, Governor, just a few weeks back, it was the same scenario.
Yeah, I don't have precise numbers, but the big risk here, whether it's for Canadians, it's for businesses, or it's for governments, is the duration of this crisis. The longer it goes, the more painful it becomes, and the problems accumulate. And so that is why, the government has come in very aggressively with very large programs to support businesses and households, to defer tax collections, to provide credit support through BCAP and other measures. That's why the Bank of Canada is undertaking, using tools it has never used before to support the economy. We can't change the fact that the pandemic has resulted in a very severe recession, the most severe in our lifetimes. The best we can do is do everything we can so that the bounce back is, our expectation is you'll probably see some pretty good numbers in the near term. As the economy reopens, that's going to be a bit mechanical, and there'll probably be a slower period of recuperation thereafter. What we really want to avoid is, a non-recovery, and that will create huge problems, and that's why these measures are so important.
Thank you very much. Inflation has come up a few times in this meeting, and you, I believe, know of the work of the Harvard economist Alberto Cavallo, who specializes in inflation and has taken a very nuanced approach to the study of inflation as it relates to COVID-19. In a recent paper, he wrote the following, and I just love your thoughts. Of course, he's writing in an American context, but like every other country in the world, Canada is also dealing with the economic impact of COVID-19. So I think his findings are applicable to our situation. But in any case, here's what he says. Social distancing rules and behaviors are making consumers spend relatively more on food and other categories with rising inflation in these areas. And he